Usually when I create these videos and we're talking about the stock market, I'm generally referencing US stocks and I'm generally using the S&P 500 as my benchmark. Today, I quickly wanted to highlight the fact that there's lots of countries with lots of stock markets and each one is performing differently at any given time. So what we're looking at here is a year-to-date number up through essentially May 1st, looking at all these different countries and their relative equity performance. So down here, we have the US market is this line right here. This yellow bar represents what the performance would look like to a US investor in US dollars. The orange dot represents what the performance looked like in the local currency. So for example, when we're looking at Mexico, it looks like they have nearly 15% performance on a year-to-date basis in their local currency. But because the Mexican peso strengthened relative to the US dollar, we've seen that as a US investor, it looks like we would have made more money. And the reason for that is when you go and you buy these Mexican stocks, you're buying them in the local currency. So when that currency strengthens, you see that you get not only the stock return, but the currency return on top of that. Down here, it can go the other way. So in the case of the South Korean won, in the local currency, it looks like it's up 15%, but because the South Korean won has weakened relative to the US dollar, as a US investor that was investing US dollars, it would look like your performance was not as good because you were buying things, the currency lost value while the stock market was going up. So this is just something to keep in mind as you're investing is whether those funds you're using for international investments are currency hedged or currency unhedged. Currency hedged performance will look like you're investing in the US dollar performance. If it is unhedged, you are also going to be subject to the local currency risk. Another thing to look at here is that, again, US markets are down here. While we've had a generally very good start to the year, there's plenty of countries that have outperformed the US. In fact, the general world developed markets have outperformed the US in the first part of this year. And for a variety of reasons, we think that trend will continue going forward just because we're looking at longer term cycles. International markets have dramatically underperformed the US market over the last decade or more, and those cycles tend to shift. So again, when we're looking at equity performance, we're looking at a portfolio construction, we want to look beyond US markets. There's plenty of opportunities around the world. And by spreading our money between different asset classes, different countries, different size portfolios, we can expose ourselves to not just the US markets, but other developing markets or other developed markets where opportunities may be better or at least different than what we have at home. So again, if you have questions about this or anything else, just let me know and look forward to talking to you.